Hi, welcome to Bloom Accounting. My name is Joe. This video will provide a synopsis of Section 84.1 non-arm's length sale of shares and its consequences. So Section 84.1 only applies to certain scenarios where an individual resident in Canada disposes shares of a corporation to another corporation with which the taxpayer does not deal at arm's length. And immediately after the sale, the subject corporation and the purchaser corporation are now connected within the meaning of Section 186 sub 4. Now, Section 84.1 will apply and essentially deem the capital gain that the individual would have made on the sale of the shares to be a dividend, thus denying the use of the capital gains exemption. So let me provide you with an example. We have Bob and Aaron, and they're brothers. They operate an incorporated business. Bob owns his shares through directly, and Aaron owns his share through a holding company. Well, let's say Bob wants out. Aaron proposes to buy Bob's shares through his holding company. In other words, Aaron's holdco will buy Bob's shares. Now recall what I said. Section 84.1 applies where an individual resident in Canada, that's Bob, disposes his shares of the corporation, his share of the plumbing business, to another corporation, Aaron's holdco, in which taxpayer Bob does not deal in arm's length. So Bob and holdco. There's no definition of non-arm's length in the Tax Act. Rather, per Section 251 sub 1, it says related persons shall be deemed not to deal with each other at arm's length. Now, for more details regarding various scenarios of related relationships, see my other video titled Tax Relationships. Finally, if Aaron's holdco purchases Bob's shares, holdco and the plumbing corp are now connected. Again, there is more details about being two entities being connected and for what purposes in the tax relationship video. Now, assuming the shares are qualified small business shares, also have another video titled Lifetime Capital Gains Exemption and Qualified Small Business Shares. So do check out that video for more details and the conditions. Now, normally an individual will have available a lifetime capital gains exemption he or she can apply to the sale of qualified small business shares. However, if and when Section 84.1 applies, the consequences are twofold. Now, the first consequence would be a puck grind if Bob had received shares as consideration in return. But in this case scenario, let's say he was just paid cash, so puck grind is not applicable. The second consequence is Bob will be deemed to have received a deemed dividend, and the corp is deemed to have paid a dividend. Essentially, what would have been characterized as a capital gain with which one could possibly use the lifetime capital gains exemption, when subsection 84.1 applies, that gain is recharacterized as a dividend, and thus the individual would not be able to use the lifetime capital gains exemption. Now, I hope this provides a synopsis of Section 84.1 non-arm's length sale of shares. Cheers.